Good morning or good afternoon, everyone, wherever you are. Welcome back to Markets for Millennials for the slightly delayed weekly recap from the week of April 11th through the 14th. Happy Easter weekend to those of you who celebrate. Coming at you on this weekend a little bit later than usual. Yesterday, Friday, on Good Friday, was the equity markets in the United States were closed. And a lot happened even in the midst of a short week. Wasn't really sure where we should start on today's or on this week's update, but I thought I would go to yields, the U.S. 10-year Treasury yield, because if we just kind of pull back a little bit here, you can see we've just been going parabolic basically since the beginning to middle of March. Just a lot of green up days. You can see here we've got this trend line that is kind of marking the parabolic trend that we're in right now. What you also see, and I believe I talked about this last week because I think we were on, this is the April 8th candle. What you actually see is we have this blue trend line, which if I go to my weekly chart and just pull back, and I apologize, it's a little bit slower. Everything's a little bit slower today. I'm traveling, so I am not at my normal setup, but you can see here that the blue trend line is kind of this big channel, and I have had times where I've cloned these trend lines up and down to show the symmetry, but just understand that there is market symmetry since the 80s. Respecting this clear long-term downtrend in bond yields, which means conversely an uptrend in bonds themselves. And you can actually see that we had an initial rejection of that area and then came and broke right through it. And this is kind of sort of, it's not an exact retest, but again, when you look at trend lines, you have to be willing to give yourself some room to adjust. Because a lot of times support and resistance is not exact, although it can be. It's often not. It's sometimes areas. So what this looks like is we've got this kind of thicker area that has made support or resistance, actually most recently support. So what it looks like has happened is we've come down and had a slight retest, and then we've basically almost, resumed up, depending on your definition of resumption. If you're going by closing prices, then the 10-year Treasury yield has made a higher high, and that means a resumption. But if you're going by the wicks, we have not quite made a resumption. So this line and many in CTM and elsewhere on the interwebs are looking at this trend line. Actually, most people were watching this trend line, and basically as soon as it started to break, everyone's kind of just assuming that the 40-year bond bull market is over, and it very well might be. Obviously, we have kind of a new dynamic, some things that haven't existed kind of converging at the same time right now. That hasn't been the case for decades. So by all means, we could continue to see yields rising. So everyone, I think it's important to watch this trend line. It doesn't mean that if it breaks, we're going to crash down or anything on the yields. But I think it will mean some sideways action for some time, maybe a pullback to kind of retrace some of this gain. I think the level that I would be watching would be obviously retesting the blue trend line or possibly even retesting somewhere that's in the neighborhood of 2.25 or 2.3% on the yield. That's what I'll be watching. The other thing that I wanted to look at was the dollar because obviously a lot of people, and I've been teasing this a lot on Twitter, but kind of ever since we popped up into this range right here, a lot of people were saying, oh, the dollar looks like it's topping, or the DXY appears to be topping, and everyone's watching for it to roll over. But if you've been following this channel, then you know that I have not been looking for it to fall, at least in the near term. I do think it could be a matter of months, weeks or months, and it may be more than a year. I don't know. But I do believe eventually we will get the dollar to come back down. But in consideration of all that's going on in the world today, it's not a surprise to me the dollar is rising. We've had a clear uptrend since May 2021. So the trend is up. And that's what's kind of funny about the markets. People are always looking for the change in trend. Everybody's always early on the change of trend. Most of the time, like honestly, people don't spot the trend change until it's long past. So, for example, just to use the dollar as an example, we came down after the March 2020 crisis. We had that spike up and then consolidation sideways, broke down, and basically came down over the course of the year, over the rest of 2020. And then we had this bounce, and then as we came down and retested kind of that low in the upper 80s, everyone was convinced, like by that time, there, what's really funny is there were so many dollar bulls for this entire time. And then people were still dollar bulls kind of in this little bounce. And then as the dollar came down here, then suddenly people started calling, oh, the dollar's going to go to the mid 80s or to the low 80s. It might even get into the 70s. And as soon as price started coming up, everyone was just expecting, oh, it's going to make a lower high. So people were looking at this spot right here and saying, oh, it's a lower high. It's going to roll over and go back down into the 80s. And did it do that? No, it did not. So we have a clear uptrend. And so people are looking for this to roll over now. I think people are looking for it to roll over because of where we're at in relation to in 2020 when we finally did kind of roll over to the downside. But my bet is going to be, people are going to be jumping in early, trying to short the U.S. dollar, trying to get the DXY to come down. They think that that's what's going to happen, but that's not going to happen. And then they're going to suddenly turn into dollar bulls right as the trend is changing. And then they will still think that the dollar is bullish. And my point is that you can't let your opinion of what you think should happen be more important than what price is showing you. And price is showing us a clear uptrend. And until it's not, then there's no reason to try to trade otherwise. The safest thing to do is to watch this lower trend line. And once this lower trend line breaks, it doesn't mean that it's going to waterfall down, but that's to me going to be the sign of the trend changes once we break this trend line. I mean, look, we're almost getting to the point where I'm going to have to extend this trend line up here. So anyway, point being, the trend is up and the trend is your friend. And so when we were, I don't know how that just happened. So when we were coming in to this range and then we started consolidating, you guys remember, if you've paid attention to this channel, I was watching kind of where that dotted line is that I just darkened or colored in a little bit more. I was watching that to see if it held. And when price closed on March 30th and opened on the 31st below that level, I thought, okay, well, what's going on? So I took my above trend line and cloned it, and here we are. And I think that trend line is actually wrong. I think I need to lower it. I think this has happened a couple of times. But anyway, you see the market symmetry there. And so I was looking at it as a flag channel kind of a situation, and go figure, it broke out of that and started to come back down. If we go down to an 8-hour chart, you can see got a little retest there. And then we had a couple of down days, and I think here again is where people started to already call, oh, it's a prairie dog fake out. And then we had just this massive 8-hour candle on Friday in the early hours of the morning. And we basically engulfed the entire previous day in one 8-hour candle, or I should say the previous 24-hour period we engulfed in one 8-hour candle. And it could have been higher, and so you actually can see that we did give a lot of that candle back over the course of the remainder of that trading day. And then I believe, yeah, because the foreign exchange markets were still trading for part of April 15th on Friday. So you can see that we had a little bit of a tiny low volume candle that day. But anyway, I suspected once we got up here, once we tested this, I was watching this, this line, right? So we were making a wedge. I was on record as saying we were making a wedge, and that it was either going to break down. If it broke down, that was going to be the trend change, and if it broke up, then I thought that we were going to go into the hundreds, and I thought it would only be a matter of time. And here we are now into the hundreds pretty comfortably. And I don't see any reason to think that we're going to break down anytime soon. Once again, you let price tell you what's happening. Don't let your opinions of what you think should be happening dictate that. So actually, what you can see is I'm adding in kind of another trend line, a little bit of a steeper trend line. You can see that has been support. So that's going to be signal one probably will be, and it's interesting to note here too, this confluence of those trend lines. So that's going to be an area I'm going to be watching. But obviously price, you got to let price show you. You can't try to make price do what you want it to do. And I think that's a really good segue into just considering, when you look at charts, I would just encourage anybody watching to don't look for price to confirm what you think, base what you believe about what's happening on price itself. Price has to come first. And I guess what I mean is, like you could come down to a 1 hour chart and you could say like, oh, look, we're bottoming right here because we're testing this area as support. Like you could go on this 1 hour chart here and draw a trend line like, something like that, and just be like, oh, look, we broke out and we're retesting, or, you can make any chart on any time frame, make any chart pattern that you want if you look hard enough. So it's best to just establish some rules for yourself. Make sure that you stick to those rules. That's why whenever I do these updates, I rarely go into other time frames other than the 1 day, unless I'm showing you something specific that was happening intraday, like I just did on the dollar a little bit ago, because there's too many subjective ways that you can get lost in the woods here, and it's best to just try to keep things as simple as possible. So in speaking of that, one thing I've been talking about lately as we transition into the equity markets is ever since we kind of bottomed out here in the middle of March, I put this Fibonacci, these Fibonacci retrace levels in here. And you guys know, if you've been watching my channel, you know that ever since we started selling off at the beginning of January, that I started adding in the moving averages as they're simple moving averages. I started adding them in as a layer of analysis. I usually don't watch them unless we're in the middle of a correction, and I'm trying to keep track of momentum, or watch the change in momentum, and it's been really helpful. You can, like I said, watching the moving averages is not really of use when you're in like this situation. If you just look at the S&P range up until we started rolling over here in early 2022, tell me when the moving averages were going to help you on anything other than a place to buy if you were going to buy on the 50-day moving average. That's where just regular TA can help you and protect you. You don't need to go into the moving averages. But here, when you're looking at what's been happening over the last few weeks, the reason why it's helpful is because you can go to previous corrections and crashes like this, and you can say, okay, well, how did price behave during this crash? Well, we came down below some of the major moving averages, came up and retested it and got rejected and came back down. And then when we came back through them and we successfully retested them, that was the clear indication that we were going to be heading back to all-time highs soon. And if you recall, after the 2020 crisis, it was during this period of time where everyone was saying, oh, we're going to roll back over, we're going to revisit the lows, we're going to have an insolvency event. And obviously that did not happen the way that they predicted. So it can be useful to look at the moving averages, but it's not something that you need to dwell on, in my opinion, all the time. It's just been relevant here. So as you can see here on the S&P 500, I've been talking a lot about this. We came right below the 786 on the S&P. And last week, when I made my video, I was watching this closing bar on April 8th, on last Friday. And I was saying, well, we closed below the 200-day again, just barely. And I was wondering if we were going to use this area to springboard back up, because this is also, we were also holding basically the 50% retrace level. And I was wondering, are we going to be able to come back up and break above the 100-day and then move up towards all-time highs? And actually, we not only did not do that, we came back down and closed below the 50-day again. So the 50-day and the 100-day are, which are obviously 50 in blue and 100 in yellow, are curled down. Our momentum is down. If you want to look at it another way, I have here, I usually don't use these indicators either, which I have the RSI, the MACD, and then just a CCI. And in every case, all of these indicators, momentum is showing downside momentum, and it's pretty clear. RSI is under 50. We've got the MACD, which is getting ready to cross the 0 line, and the blue line, which is the main line, is about to cross, and it's definitely clearly downtrending below the signal line. And then obviously the CCI is down into negative territory, down below the average range. And so you can use all of these indicators. In this case, it's showing you price is in the process of rolling over. It doesn't mean that we will roll over. Actually, this spot that we're in right now, that we closed at, is a place that I would look to catch support if we're going to do that, or the 236 level, which you notice is coinciding with back here in the end of January, where we had a bounce as well. So I'm going to be looking at those potential areas to catch support and bounce up if we were going to move to the upside. However, like I said, those indicators are showing our momentum is to the downside. So I could totally see us rolling back over, which actually this is kind of something that I talked about being careful over the last few months. I've been talking about being careful because price, you don't know what price is going to do. So this is why you have to pick levels that are safe and conservative, and otherwise you could get caught on the wrong side. So I'm just curious here. Let me see. I'm trying to turn this on. Sorry, I'm doing this in real time. Okay, so yeah, so this trend line right here, in order to retest it off of this breakout, in order to get a true retest, we would have to come down almost to that 0 retrace where we hit our low back in mid-March, right before the FOMC meeting. And I mean, could we do that? Sure, we could. I would be really concerned if we did come back down that low that quickly, but definitely could see it happening. Let's go to the NASDAQ so we can get a look here. I talked about the confluence of the moving averages, the cross here of the 100-day, both of those also coinciding with the 618 Fibonacci retrace level. We did the same thing that we did on the S&P. We came down below the 50-day and have been rejected off the 50-day. And we are kind of at that zone right before the 0 area that I'm looking to hold support if we're going to establish a higher low. So both on the S&P and the NASDAQ, we're looking for kind of staircasing higher lows if we're going to show that this kind of correction is over, and that if we're going to move back to the upside towards all-time highs. Now, remember, on the NASDAQ and on the Russell, we actually did cross into bear market territory with 20% down. And so in order for the bear market, so to speak, to be over, we have to get back to all-time highs. So that's just another thing to keep in mind. Going to the Dow, because I don't want to start on the Russell yet. You actually can see I added these little trend lines. I was curious to see if we were getting kind of a mini flag off of this bounce, and it's possible, but our first test of that, we came up and hit the 100-day moving average, and it faded back down into that channel. On the Dow is the only one that did not come back below its 50-day moving average. And so that is actually, let me double check before I say, yeah, that's right. Okay. I couldn't remember on the S&P from what I just said a few minutes ago. But you can actually see, like I talked about last week, we got that cross on the 100-day down below the 200-day. The trend is clearly down on the Dow. But again, holding out hope that potentially we can establish some kind of higher low. And here we've got actually, again, two opportunities at the 382 and at the 236 before we get down to that zero level. So that's going to be something else to watch. If it hasn't already become clear on the equity markets, the trend is down. Just as the dollar trend is up, the equity market trend is down. You can actually see the Russell is sideways. It underperformed on that bounce, but now it's actually outperforming on the downside following the bounce, which is kind of interesting. But again, technically speaking, it is worse off than all of the other indices, and so I feel like the Russell has been a really good indicator for the other equity indices. And I've said, I said for all of 2021, the Russell is a more clear indicator of the actual state of the economy. And so because the Russell wasn't breaking to new all-time highs, basically for all of 2021, except for that little prairie dog fake out, what to me was an indicator that that things were not actually going so well under the hood. And so I'm expecting, again, like, got to watch those levels that I talked about on the other equity markets. But to me, it looks like the trend is down. If we just go to our momentum indicators here, our more near-term momentum indicators, we actually did get a MACD cross on the NASDAQ below the zero line. The CCI is down. The RSI is below 50. On the Dow, we are actually not down into below the average range on the CCI. We are just barely below 50 on the RSI. The MACD has not yet gone negative, but actually this MACD looks a little bit better than the others. And then on the Russell, we are kind of similar, below the zero line on the MACD, but kind of leveling out. RSI below 50, CCI kind of in the average range. So that's just, those are just more indicators. Let's take a look. I wanted to kind of jump over into the currency markets because I want to show you. Here I have the risk on, risk off trade. Australian dollar versus Australian dollar and the New Zealand dollar versus the Swiss franc and Japanese yen. And we're kind of sideways for this week. Maybe a little bit down in comparison to, so the New Zealand dollar is a little bit down versus the Swiss franc. Australian dollar is up a little bit versus the Japanese yen, but mostly sideways, basically unchanged for the week. And so that's something definitely to be looking at as well as an indicator. Again, it's not enough, like I showed you this, these momentum indicators. I have my moving averages and things like that, but you have to be willing to also try to confirm across more markets, because, for example, the currency markets can often tell you what's happening before a lot of other things can. And so you guys know I've been watching the risk on, risk off trade for a while. Okay, so let me turn off my moving averages, and we're going to shift over into gold. And if you look at gold, I've been tweeting about this. Let me just highlight this level really quick. I've been tweeting about this a lot. Gold is in a no man's land. You guys remember, if you've been watching this channel, I've talked about how, all the way through this kind of, rounding bottom looking pattern here, or formation here, I have long talked about, even when you draw You could just draw these trend lines, whatever you want to draw. You could talk about the break of those trend lines all you want, but I've been saying for over a year that I was not going to get excited until gold got above 1916, which it came up and it did that. You even probably remember that back here, kind of in this area at the beginning in January, I was talking about I think gold's time is coming. We had the Russia-Ukraine war premium lead it towards its all-time high, although it did not make a new all-time high in terms of highest price ever traded at. We gave a lot of that war premium back, and we were kind of stuck in this no man's land. So I've been saying, below 1916 is more bearish. Above 1967 is super bullish, and in between is no man's land. And so we just kind of broke out of no man's land. If I go down to the 8-hour chart, you can kind of see how we were toying with that level. We wicked below it on Friday's trading session. Now that gold is above that, I do believe that gold is going to kind of more slowly march now to the upside, especially now that we've begun the rate hike cycle. We've got one rate hike in. That's almost always the best time to buy gold. That's something that Jordan Lindsay has been on for a long time, has really been one of the firsts to be talking about that. If we shift over to silver, silver is a little bit more of a disappointment in that. We broke out from this trend line that I had put in, but we are below a pretty key level, which is 25.75. You can see that level has been a support and also a resistance. I would say that is sort of a little bit of a no man's land. But then a lot of people have been talking about this entire sideways range is a no man's land. So it's going to take a lot more to get excited about silver. Let's take a look at oil. I've been watching this for some time, as most people have, but one of the things I was watching was that on this sell-off from the war premium, we got this bounce to the 618 and kind of we're selling off. And what I'm going to be watching for, particularly in this case, we broke out from this trend line. I'm going to be watching the 382 Fibonacci level. I'm going to see if we get rejected off that and come back down, because I could be completely wrong, but what I think is bound to happen, what I think is more likely to happen, is I think we're going to spend a little while kind of, how can I say, bottoming out, kind of regrouping, kind of like blowing off, like giving. I don't even know what I'm trying to say. I'm a little mixed up today. I'm sorry about the flow. I think we're going to just spend some time consolidating down in this area before eventually taking back off, because I do think the bullish case for oil is huge. I think that just given everything that's going on, I've talked about this a lot in my videos, on my newsletter. I think that the case for oil is that it's going to continue to increase in its price, not decrease, due to inflation, due to all the supply issues, because of the lack of investment in infrastructure, due to the COVID shutdowns. All of these factors are converging, and I think that that's bullish for energy, even though if you really think about it, from when it went negative back in April 2020, it has come up a long way since then. Taking a quick look at Bitcoin, I've been recording now for almost 30 minutes. So I'm going to try to get this finished up and wrapped up. I've got a lot of lines. I've got a really messy Bitcoin chart. I added in what a lot of people have been watching, kind of what they've been saying, a bear flag. Although, in my opinion, it's not really a bear flag if the flag itself is almost as long as the price decline, which is just about where we're at right now if you're going from when we first got into our channel. But it is something I'm watching. Price continues to respect the lower trend line here, and we're continuing to make higher lows. It's frustrating, I know, for a lot of people who, everybody wants Bitcoin to do, what it did over here, appreciating, gosh, I don't even remember, from the initial like breakout, appreciating a couple 100% or more. Everybody wants that to happen really fast. They want it now. They want instant gratification, but it's slow. It's been slow, and so I feel like that has been harder for people than some of these actual sell downs. And I think it's because of that you have most people, I think, believe that this is going to go down further. I still, to this day, I'm still seeing people, talking about going back down to 10,000 to 20,000, or potentially even lower. And then you've obviously got your Peter Schiffs out there who are calling, Bitcoin's going to go to zero, and he's been saying that since Bitcoin was at $1 or at less than $1. Something I continue to watch is our most important trend line in crypto. We did get that breakout. And one thing I talked about was how the last time or every other time we get those breakouts from a significant consolidation, price usually moves 20 to 40%. That didn't happen this time, but one of the things that I think is important to recognize is that from our low, price had already come up if we count from this wick, price had already come up 47%. It just so happened that it took a long time for that trend line to break. So anyway, I'm not really certain if that's going to happen again, if we're going to get that kind of price movement, but that was something I'm watching. I still think the outlook is good, even though a lot of people are saying, risk assets are something to be bearish on. I think it's a big deal that that Bitcoin continues to make higher lows, and even, in relation to its near-term price action since 2022 started, it is making higher highs in this trend. I think that's a good thing. A lot of people, though, are bearish, and honestly, anything could happen. But if you start in a position of power, like I did, getting in early, and like many people did getting in early, then you have nothing to worry about. Continue to dollar cost average. And I saw this amazing statistic. If you had been dollar cost averaging since the high at 69K, if you bought, I don't remember what the statistic was, but if you bought, was it daily? Then technically you're still above. It was a wild statistic. I don't even remember. You could probably look it up. I don't remember who posted it. I don't remember if it was Dylan LeClaire or something like that. But anyway, I still think it's good. I still think Bitcoin's prospects are high. And honestly, let's just turn on the log chart and put it on a 3-day for a second. If you hold Bitcoin for at least 4 years, you never lose money. And while everybody wants things to happen now, everybody wants Bitcoin to go to 1 million right now. The reality is you don't need to be in a hurry. Don't be tempted to lose interest and try to trade in and out, or to try to jump in or FOMO into other things where price is actually doing something, because that's always a way to end up losing money in the end. So yeah, I think you just have to be patient and let Bitcoin do what Bitcoin does. And that's going to do it for this week's recap. Again, I apologize that it's a little bit long. I apologize that it's coming a little bit later than normal, but I do appreciate you all tuning in. Thank you for watching, and don't forget to like this video if you thought it was good analysis, if you thought it was helpful. Don't forget to share it, and I'd love for you to sub if you have not subbed. Anyway, thank you for watching, and I will see you guys next time. Hope you guys all have a great weekend, and happy Easter.